Hello and welcome to this session. This is Professor Farhat. In this session, we're going to look at gross income exclusions, and specifically, we're going to be looking at life insurance proceeds. This topic is covered in an income tax course, the CPA Exam Regulation, and the Enrolled Agent Exam. Now, before we start, I would like to let you know that I would like to connect with my viewers, and that's you. I'm very active on LinkedIn. Please connect with me on LinkedIn. If you don't have a LinkedIn account, you should. It's very good for your professional image, and this is how you build your network. I'm very active there. I do post my lectures as well as other recordings and news related to the CPA. If you're a Facebook user, please like my Facebook page and connect with me on a personal level. You want to make sure you subscribe to my YouTube channel because this is where I house all my lectures. I also have a Twitter account, and you could. Life insurance proceeds. What's life insurance proceeds? Basically, it's a life insurance policy, and when you pass away, someone gets the proceeds. A beneficiary gets the proceeds. Okay? Generally speaking, exempt income to beneficiary if paid solely due to the death of the insured. So someone passed away, they have an insurance policy, and you're the beneficiary. Beneficiary is you're the person that's getting the money. Now, why did they put you the beneficiary? Because they want to make sure you are in good standing. For example, I have a life insurance policy in case something happened to me, my wife gets paid, and my son. Same thing, my wife. If my wife, something happened to my wife, I'll get paid, and my son will be paid just as a life insurance proceeds. And the relationship, this has nothing to do with the decedents. Okay, so you could be a beneficiary, and the relationship is not relevant. Okay. Now, if you have a policy, a life insurance policy, and you cancel the policy and you receive the cash surrender value, because what happened when you pay the premium into the policy, the premium will increase in value. That's called cash value. If you happen to cash out, you can cash out. If you happen to cash out, guess what? You're going to be taxable on the cash surrender value. So gain must be recognized to the extent amount received exceeds the premium. Now, the premium is your original money. It's your return of capital. Okay, you don't pay money on the taxes on the premium, but anything, if the policy went up in value, that increase in value, it's going to be taxable to you. Now, if you have a loss, the value went down, then guess what? The loss is not recognizable. Okay, those are the general rules. Accelerated death benefit. What is that? It's when you are paid from your life insurance policy earlier. Gain on cash surrendered or transfer of life insurance policy by terminally or chronically ill individual is excludable. So basically, if you have cancer and you needed that money, then it's excludable. Okay? Exclusion for chronically ill is limited to the amount used for long-term care. So the excludable amount, if you have something called long-term care, if you're in need of that, then that's excludable. Now, transfer for valuable consideration. What happens if you transfer the policy and get something in return? So basically, you are trading it. You have an insurance policy and you're trading it. Okay? If the policy is transferred for valuable consideration, proceeds are taxable to the extent that they exceed the amount paid for the policy plus subsequent premium paid. So obviously, what you paid for it plus any subsequent premium paid, anything that exceeds that, that's going to be taxable. Now, there's some exceptions. We don't have to worry a lot about those exceptions. If you're facilitating the funding of a buy and sell agreement, if you have a tax-free exchange, or if you are the receipt of a policy by gift. Don't worry about this. Just know that exceptions exist, but you don't have to worry about the exceptions. Just know that they exist. Okay? Now, bear in mind that when you have a life insurance policy, most of the time when you try to cash out, when you try to get your money out, I work with Merrill Lynch. We did not do insurance, but I can tell you, companies don't like to pay out. Finance companies don't like to pay out. So if let's assume you have an insurance policy and you qualify to receive $1 million. What's going to happen? The insurance company, they're going to go out of their way trying to convince you to do what? To keep that money. Okay, so rather than $1 million, what they would say, why don't we make payment to you? Now, when they make payment, they're going to be making payment for more than $1 million. Okay, because that's why they're going to convince you. They don't want you to take the $1 million out. They might be making payments, and those payments, they might add up to be, if you add them all up, to $1.3 million. Now you're willing to wait because you're going to be getting $300,000 more over a period of time. Okay, so that's the investment. Investment earning arising from the reinvestment of the life insurance proceeds are generally subject to income tax. Why? Because now it's kind of basically interest to you. Okay, the reason you kept the policy is because you're getting something. So the $1 million is not taxable, but the earnings, that $300,000 is taxable. Okay, so what you did is the beneficiary elected to collect the insurance proceeds through installment. Installment means payment. Okay. Now what we need to do, the annuity rules, if you remember what we did learn about annuities in the prior session, are used to appropriate the installment payment between principal, which is the excludable amount, and the interest element. And we'll work a quick example to show you this. So the original life insurance policy is not taxable, but any earnings on that insurance policy will be taxable to you. So let's take a look at this example to see how this works. Donald was killed in an accident while he was on the job in 2018. Donald's wife received several payments as a result of Donald's death. What is Darling's gross income? Okay, so Donald's employer paid Darling an amount equal to Donald's 3-month salary, which is what the employer does for all widow or widowers of deceased employees. Simply put, this is like a severance pay. Okay, well, guess what? Severance pay is a form of compensation. Therefore, she received $60,000 and she would include $60,000 in her income because that's a form of compensation. Okay, what's that compensation? 3-month salary. So once you leave, it's a form of compensation. B, Donald had $20,000 in accrued salary that was paid to Darling. Well, guess what? Donald earned it. It's a compensation. It's paid to Darling. It's still compensation. So Darling will have to include that $20,000. Donald's employer had provided Donald with a group term life insurance of $480,000, twice his annual salary, which was payable to his widow in a lump sum. Premium on the policy totaling $12,000 has been included. Doesn't matter, it has been included. So life insurance policy excluded. So why? Because he passed away and the wife is the beneficiary. That's excludable. Okay. Donald has purchased a life insurance policy. Premium total $250,000 that paid $600,000 in the event of an accidental death. So what he did, he bought an insurance policy, and in case something happened, they will pay his wife $600,000. He happened to pay $250,000 into that policy. The proceeds were payable to Darling, who elected to receive installment payment as an annuity. So what happened? Darlene said, "Don't pay me the $600,000. Why don't you make installment payment of $30,000 for the next 25 years? Well, let's see what would happen then. If they're going to pay her $30,000 for the next 25 years, Darling would receive $750,000. But the policy originally paid $600,000. Well, guess what? Then under those circumstances, we find the ratio that we learned about. The cost, the investment, $600,000 divided by 750. We're going to find this ratio and multiply it by 30,000 to find how much we are going to exclude, because the payment is 30,000. So let's go ahead and do so. 600 divided by 750, that's 0.8 times 30,000. So we're going to exclude from the $30,000 every month. We are going to exclude 24,000. Therefore, every year. The annuity is for a year 30,000. So we're going to exclude 24, and the taxable amount is 6,000. So what's the difference between C and D? And C, she elected to have the whole policy for 80, therefore the whole thing is tax-free. And D, she elects to receive payments. Well, guess what? The $600 would still be tax-free in total if she waits the next 25 years. But since she received an additional $150,000, that additional $150,000 will be taxable in form of $6,000 every year. Okay, so remember, the $600,000 is tax-free. The difference between $650 and $750, which is the amount she would receive, is taxable, but it's going to be taxable over the years. If you have any questions, any comments about this session, please email me. If you're studying for your CPA exam, this topic you need to know, I'll make sure you're aware of it. If you're studying for your college course, make sure you do so. If you visit my website for additional lecture, please consider contributing.